Today, I'm going to be talking about reverse mortgages. Oh, but not in the way that you might think I'm going to be talking about reverse mortgages, I can assure you. Let's just go back. Let's take a little kind of if I'm a bank and I want you to be my client for your entire life history lesson, how this actually works. So if we rewind our lives till we're very, very young, I wonder how many recall that banks often did and still do offer youth accounts where kids under the age of 18 can deposit their money and take out their money. And sometimes there's a parental supervision to that, sometimes there's not. It depends on the age. And that's to get younger minds used to working with banks. Now, let me preface all of this by saying I'm not against banks, I'm not for banks. For me, banks are simply for storage. Excuse me, let me reverse that. Banks are not for storage. They are in fact for transactions. And the idea of keeping too much money in the bank, I think, is just a terrible idea altogether that I'll cover in different episodes. But we're eventually going to be talking about reverse mortgages today. And do they make sense? Do they not make sense? Is there another alternative that we should consider? So, going back to this youth account, it's there to ensure that you work with the banks from a very young age. And then you get to be about 18 years old, and that's about the time you get your first debit card or credit card. Now, you'll notice that debit cards and credit cards look quite a bit the same, right? They're very similar. They're very, very different. And we'll go into that in a separate episode. But you're used to carrying or having an app on your phone with your bank or your financial institution uh, accounts. And you're also having access to your debit and your credit accounts, as well as to any money that you might be borrowing. So you might have a mortgage account. Well, that brings me kind of to the next point. So you're 18, 19, 20-ish, and you go get your first car, and you're automatically thinking about the bank. So you get financing either through your own bank or you lease a car through a leasing company, which is nothing more than somebody going to a bank. And they've got you for what, 2, 3, 4, 5 years, how many years, 60 months, whatever it is. And then everybody's conditioning you to want to get a mortgage. You should own a house. Now, whether that's true or not will be yet another episode. But for right now, I'm showing you the way banks work, the way banks think, and the way we're conditioned to working with banks. So by the time we get to this mortgage thing, we're going to go get this house and we're now going to get a mortgage, and we're going to have that mortgage for 25 to 30 years on average. And that brings us into our, depending on when we started, mid 40s to mid 50s, depending on where we are and how many years. And along the way, as we built up equity, hopefully in our home, the bank has been inviting us to take out either lines of credit, or they've been inviting us to refinance, to be able to pull out money to do stuff we want to do. And yes, that'll be another episode. Why? Because you'll notice in all the ads on TV and wherever you're watching them today, you're going to notice that they never tell you to take out money to make money. They only tell you to take out money to buy stuff that you want that will depreciate in value, or to pay off and consolidate debt. When was the last time that they said, oh, take a refinancing on your home and go invest that in the stock market, or go invest that in real estate, or go invest that in precious metals? They never tell you to do that. They're not technically allowed to tell you to do that. That's why. But they can say pay off your debt, pay off, consolidate your high interest debt. You know that Visa card that we gave you a few years ago that you've racked up $5,000 at 26% interest? Go pay that off with another loan from us. You get how that works, right? Well, you get to a certain point in your age where they don't want to give you any more money long term. So they figured out a way years ago to reverse a mortgage. So If you get a mortgage for 25 years and you don't refinance it, and you're 65 years old, you can get a reverse mortgage for as long as you're going to live, which could be another 25 or 30 years, depending on, good luck. And so they pretty much got you your whole life. And at each stage of the way, I think it's really important to notice who's pitching you. You know what I mean by pitching you? So who's talking to you when you're getting a mortgage, your first mortgage on your first home? You'll notice the ads are young families. Who's pitching you when you're getting a reverse mortgage? Oh, it's some celebrity that was in their 20s or 30s 30 years ago or more that you recognize, that you have immediate trust in, because they want you to trust another gray-haired person to be able to say, hey, this is a great idea. But you'll never get an opinion from that celebrity endorser. You'll just say, so and so thought it was a good idea for them, or so and so did that, but they never said that I think this is a good idea, because that would open them to liability. So if you pay really close attention and you read between the lines, you can clearly hear the difference. Now, that brings us up to a reverse mortgage. So, what the heck is a reverse mortgage? Well, these are designed really for people that want to access money in their senior years. Normally, you can't take one out before age 60 or 65, depending on the type of company that you're working with. And they're going to basically give you back your own money. And that's what I love when they say tax free. Of course, it's tax free. It's your primary residence. So there's already a tax free aspect of a primary residence. So you're 65 years old or you're 75 years old, and you go to a bank and say, I want to take out a refinancing mortgage. And maybe you don't have the money to make the monthly payments, or maybe the bank thinks you're too old. You might not make it to the end. They don't want to foreclose on you. It doesn't look good. They offer you a reverse mortgage. And all a reverse mortgage really is a line of credit that you're taking every single month as income. It's not subject to tax, and there's no need to make any payments. Now, when things sound too good to be true, I don't automatically believe that they're too good to be true, but my little radar goes off and I want to verify everything. So I'm a great believer in trust but verify. So you have to look at the specific rules, and I've printed them out. I'm not going to put them on the screen. I've put them on my screen so I can refer to them so I don't make a mistake in sharing this information with you. So there are pros and cons, obviously, of this reverse mortgage, of taking your own money in the form of a reverse mortgage without having to make any payments. So the number one pro, obviously, is having access to additional income you didn't have beforehand. You don't have to make any monthly or annual payments, but you have to start thinking to yourself, well, if I'm not making any payments, what's going on behind the scenes? And then you do get to live in the home. You do get to retain your home ownership. I would say those are the big three reasons why people consider a reverse mortgage. Now, the downside of a reverse mortgage is that you're accumulating a lot of interest because you're not making any of those payments. Imagine if you had a regular mortgage and your regular mortgage had $2,000 a month in payments that you were supposed to make, and you didn't make them. Well, instead of the bank foreclosing on you, the bank would turn around and say, okay, listen, you're a great customer. We're going to add the amount that you didn't pay us this year, 2000 a month times 12 months, which is 24,000. And we're just going to add that on to the total you owe us on the loan. Of course, plus interest, which now means you're paying interest on interest. And that just keeps accumulating and accumulating and accumulating. In fact, when you do that with a mortgage, it's called a negative amortized loan, or a negative amortized mortgage, or a negam loan if you want to be the cool kid on the block. So what is a reverse mortgage but a negative amortized loan? That's really what's happening. And of course, you also have fees and costs that might be even more than just simply having another financial vehicle that might be available to you. And lastly, and people seldom consider this, is that you might have some, or there might be some impact on benefits that you're currently getting, Social Security benefits and things like that. So you have to be careful. You have to be aware of what, if any, impact might be there. Now, I often ask the question, if I need this money and this is the only way, I often ask this question, is there another way that I can get the same thing done? How could I get the same thing done? Well, I guess you could borrow money from a friend or family member and not make any mortgage payments, and they won't have any crazy fees, but they will charge the amount that you owe. And when do you pay it back? Well, you pay it back upon death. And what that basically means, just like a reverse mortgage, is when you pass away, then the property will be sold or the amount will be due. Maybe the estate wants to keep the house, so they'll pay off the loan. So, what started as a house that was paid off in full might end up owing the reverse mortgage company 200,000, 300,000, 400,000. Now, if the house is worth $1 million and you sell, not you, but your estate sells the house and pays off the loan, they're still going to walk away with $600,000. That's fine. If you owe more than the house is worth, there's an insurance component normally part of reverse mortgages. So your estate shouldn't get whammied there. But again, read not just the fine print, just read it all to see, is there a penalty upon your passing, that if the property is not worth at least as much as what's owed, what happens next? Your estate may want to pay off the loan. Your estate may want to keep the property. Your estate may want to sell the property. Whatever the decisions are made through wills and stuff like that becomes the decision of you and or your estate, depending on how that's been set up. So you could borrow money from somebody and they're just paid back upon your death, compounded interest. It's one way. It's probably saves you a little bit of money. But the other way, which is probably the most obvious way, is, can I use a home equity line of credit and accomplish the very same thing? And the short answer is yes. A home equity line of credit is a fantastic alternative to a reverse mortgage. And yet, there are caveats to being able to do that as well. Because by definition, the home equity line of credit would require monthly payments to be made. Now, you might ask, being clever, you say, well, could I make the monthly payment from the line of credit? And the answer is yes. And then you're back to the same issue of compounding your payments, right? So that's not really helping you at all. But if you could make payments back to yourself, but then I guess, like, why do you need all that money at that point? So it really just becomes, yes, you can do it. Uh, there does become a risk of foreclosure if you don't make payments as compared to a reverse mortgage. And you may have to have an income and credit requirement threshold to be able to get a home equity line of credit, at least if you want as much as might come out of a reverse mortgage. Typically, if you wanted a smaller amount, maybe not so difficult. But there are a lot of factors that you want to consider. And again, just to make sure I don't miss them, I put them down on a piece of paper in front of me. So, number one is your income needs. What are your income needs? If you need steady income without monthly repayments, then a reverse mortgage might be suitable for you. Then number two is going to be your upfront costs. You have, if you want to minimize your upfront costs, then and maintain flexibility, then you might want to opt for a home equity line of credit. And if credit and income thresholds are in your favor, then a home equity line of credit will probably save you an awful lot of money. And if they're not, you may not have that option other than to borrow from an individual that you may know. And of course, I know it's a tough one, but age and longevity. At what age are you starting? What does longevity look like? What health are you currently in? What's your best guess? There are actuaries that actually try to go ahead and figure that out. So, coming right back to the beginning of my thought about, banks want to keep you a customer from pretty much the day you're born till the afterlife. I just don't want you to automatically, if you find yourself or a parent or a grandparent in a situation of considering a reverse mortgage, I don't want you to automatically say yes. I want you to think about, What other alternatives are there? I want you to get all the information before you make any quick decision. And I want you to be aware of your options all at the same time. So, as many of you know, I talk about money and investing. I try to clarify as best I can these concepts to take away the fear and make life easier for you to make more money and have a better quality life. Until I see you again, this has been Stephen Libman, your host, and I look forward to sharing more with you in the next episode. Take care. Be well.